Hey everyone, welcome to Make Money Count. Sitting here with Marcus. Today we're going to talk about confidence. What kind of confidence? Consumer confidence.
And business confidence.
And business confidence. Yeah. There was an article you pulled up, some charts. We were looking at them. Tell us about it.
Okay, so the Bank of Canada, first off, the Bank of Canada is meeting on July 30th.
It's going to be a big nothing.
And the expectation is that it will certainly be a big nothing.
Yeah.
Which is unfortunate for consumers,
Yeah.
borrowers, anybody with a mortgage, anybody that wants to borrow money, anybody that's selling stuff that requires money in order for it to be bought, for everybody.
Right.
The weird thing is that even if we got 25 basis points on July 30th, it's not going to resurrect anything in this market.
It would be a little or nothing.
Yeah. And we can probably look to the September, October, December meetings for the reprieve that we are hoping for. And it will be dependent upon, again, that core CPI number, which is heavily dependent upon trade certainty with the United States. And economics are fun because of how many intertwined variables there are, and how many of those variables impact each other. The Bank of Canada issued 2 reports at the beginning of this week, and I want to look at 2 charts from those reports that I found really interesting.
Okay.
The first chart, and we'll pull it up here, the business sentiment as it has been tracked, and it's basically they poll businesses in Canada and ask how they're feeling about the market, their marketplace, whether they're planning on investing more capital in their business, on hiring people, on firing people. And you can see there's a little bit of good news here in that off of the ultimate low of 0, so very difficult to go down from there,
0
I suppose.
confidence.
We are off of the lows now, which is somewhat encouraging. Of course, this preceded several a Globe Mail article, a Financial Post article. I'm sure there were more of them. Those are the ones that I saw, but that went into detailing that, generally speaking, businesses in Canada are no longer fearful of the quote unquote worst case scenario for the tariffs.
Right.
And as a result, they're kind of maintaining their staff. They're not getting rid of people, and they are, for the most part, not passing off price increases to the consumer.
Right.
Because of the elasticity of the demand of the consumer, meaning that consumers would most certainly stop buying or buy less if the provider of the good or service increased their price.
Right.
And as a result, because of that response and because of the kind of obviously muted but somewhat higher confidence of these businesses, the Bank of Canada should be slightly encouraged that core CPI number won't go up too much.
Right.
Although, again, economics all intertwined. Conversely, they may be slightly worried in that those same businesses are saying that they aren't going to shed workers from the workforce. And as a result, it would maintain some strain in the labor market to some extent. Although, like, we did see an employment reading come out slightly better than the previous reading.
Right.
And that may speak to this confidence here. But that means, as you know, if the labor market tightens, then the inflation can pass through further and become more entrenched in the economy. Although, again, I don't see that happening, not with like a close to 7% unemployment rate, but it is something to monitor, right? Like, if the employment market gets stronger, then inflation passes through and gets held in the economy. That becomes more likely.
Right. And that's a bad thing.
Yeah. Generally speaking, inflation would be bad, especially for our business, because, you know, we want people to borrow money as cost effectively as possible. It's like what we do, the mortgage side of things. But yeah, that's a really good question. You know, honestly, there are no bad questions, probably with the exception of that one.
That's not what I meant. But I do agree that inflation is bad. It's bad.
What did
It's
you
bad.
mean?
We talk about there's a word that you know that I don't for it, but when the labor market is strong and inflation creeps in, it usually stays around for longer. What's that called?
Entrenched?
Entrenched. Yes. That's bad.
Oh, yeah.
That's significantly worse than just inflation.
Yeah.
Yeah.
Well, no. Entrenched inflation just means like it's going to stick around. This
Right.
like transitory or like temporary inflationary pressure is actually something that the Bank of Canada or any central bank doesn't really care as much about. Like
Right.
one-time inflationary shocks, they're not as worried about.
Of course. Yeah.
Can't really fight that with monetary policy.
Right.
Yeah. Okay. Yeah. There's one more chart here I want to look at. This one's more pertaining to the consumer and just how beaten the consumer is right now. So this is a new indicator that the Bank of Canada has come out with. It's the CSCE indicator. Okay, so if we pull this one up, it's the CSCE indicator.
The sissy.
Yeah, the sissy. And yeah, like these numbers look a little sissy right now. But it's a new indicator the Bank of Canada has put together. It's a consumer indicator, basically how the consumer feels about various parts of the market. So how they feel, the blue is how they feel about their job security. The yellow is how they feel about the overall financial health of their household and the economy. And then the final green is their consumer spending index. And as you can see, no es bueno.
No es bueno.
Yeah, it is not the lowest it has been, but it definitely seems to be trending lower. And this just means that people are scared, right? They're scared that they're going to lose their job. They're scared that they don't have enough money to cover their expenses. And they are scared to even spend money in this market.
Right.
So listen, all of this, if core CPI wasn't increasing or hovering around 3%, would make like a 50 basis point cut
it would be good
on the table. But instead, what we're seeing are bond yields going up and core inflation higher, stickier than what we want it to be, and a Bank of Canada that is sidelined. And unfortunately, the longer this plays out, the more likely we reach stagflation.
Right.
Stagnant, no growth in the economy and inflation simultaneously, completely sidelined Bank of Canada, and an economy that just goes sideways to down.
Right.
And until we can change rates or affect some change on this overall malaise in the marketplace, we're going to be stuck here for a little bit.
Depressing.
Unfortunately. But look on the bright side. It probably will get better.
We're not Greece.
Greece is doing better than Canada right now. Greece is doing better than Canada.
That's
right
true.
now.
Yeah. All right. Thank you so much. Talk to you again soon.